Hey everyone, this episode is brought to you by River, the place that I personally go to securely invest in Bitcoin with confidence and with zero fees.
Inflation is going to pick back up. I think stock prices are going to pick back up. I think you will get talk of rate cuts going away and possibly even rate hikes. And I think the surprise will come around mid-year when the rate hikes don't come. Everyone that is like, okay, they're managing this thing for inflation, that will be the moment where they go, oh my God, they're managing this thing for deficit. They're managing this thing for treasury functioning. That's when you're going to see fireworks.
So here's where I want to start this, Luke. Warren Buffett, Berkshire Hathaway, just came out with their shareholders letter. $167.6 billion in cash sitting on the balance sheet. What in the world is going on? 167 billion in cash. So the reason I want to start with this question is because I think it just encapsulates the confusion that everybody has with what's going on in the market right now from a macro standpoint, right? You have, some would say, the best capital allocator that's ever lived squatting on, just an absurd amount of cash. You have Jamie Dimon that has sold some JP Morgan stock to a pretty sizable amount. You have Jeff Bezos that just sold a bunch of Amazon stock. I think it was to the tune of $5 billion. What is your take on this? Because I have some really strong opinions, especially on the Berkshire Hathaway one, but I want to hear what your takeaway is on some of this.
To me, it's very interesting. Warren Buffett, even in this year's annual letter, he references March of 1942 as being the first time he bought stock, and it's sort of been a straight line up ever since, etc. And I always find it interesting that he has referenced this 1942. I bought my first stock when I was 10. It's been up and to the right ever since, etc., etc. Like, he fails to ever mention, as far as I'm aware, what happened. Number one, it's very lucky timing, right? The Battle of, was it the Battle of Midway? 2 months later, 3 months later was like the generational bottom in risk. We were going to win the war. It's just a question of how long. Up until, okay, setting that aside, he fails to ever mention what happened to stocks and financial assets from 1914 or 1900 or through 1942. And if he ever mentioned that, he would have to say, I need to own some gold, or I need to own some Bitcoin, or there's the currencies and financial paper assets can decline massively on a real basis. And of course, he knows this. If you read some of his letters from the 70s, maybe the 60s, probably the 70s, talking about how there was a 10-year span where the book value of Berkshire Hathaway went up X percent and the price of gold went up X percent, which means we have created no value in real terms. It's all been inflation. So he clearly understands these concepts. But I think for the average investor, yes, I understand his message, and I think it's important for the average investor to understand, there's a long cycle, and he happened to have bottom ticked the long cycle with his first purchase of stock, and congratulations to him. That's great. Doesn't necessarily mean the next 77 years are going to go like the last 77 years. And so that's, broadly speaking, those are my thoughts. There's a lot of corporations with a lot of cash. That is part of a broader theme. I think I look at that cash as tender, as fuel for more of a rally in risk assets, broadly speaking. Obviously, I like Bitcoin. I still like gold as well, but that's how I think about that corporate cash.
Well, so I agree. I think that when we're looking at the amount and what he's squatting on, it's basically signaling that he is waiting for equity to become much cheaper price than where it's at right now, and he's going to swoop in and buy and gobble it all up. I mean, he's been squatting on a pretty He's been squatting on over 100 billion for what feels like a decade at this point, by the way.
Yeah, he's had a record high cash every year, other than I think 21 and 22 for like 10 or 12 years. And it highlights the advantage of his structure, right? Because the reality is that if he was an investment manager sitting on record cash every year for the last 10 years, he'd have been out of a job like 7 years ago.
Yeah.
And that's the advantage of what he does. You know, I think it's also really interesting that he's playing for a correction, clearly. I agree with you on that. And he talked about in 2020 that the Fed acted so fast because the Treasury market broke so fast that he didn't have time to deploy that cash. And like, that's the guy who's getting the first call from everybody.
Yeah.
Like, he didn't have time to do it and has the mandate where he can be like, oh, yeah, that's a good deal. Here's 20 billion. And he didn't have time to do that last time. And so I question, A, will he have time? And B, will sort of like the average investor have the time to do it? Knowing, again, I think it's super critical because there's another way. Let's turn the cash around the other way. Corporations have, Buffett's got whatever, 167 billion. One of my dear friends in the business highlighted to me last week. I didn't realize this number. He said that corporations in aggregate are sitting on somewhere between $4 and $5 trillion in cash, I think. And I suspect it's highly concentrated at the top. But here's the point. If there's a downturn of any real magnitude or severity, corporations are sitting on somewhere between 4 and 5 trillion in cash in aggregate, and they termed out all their debt. So in the downturn, corporations are fine. They can go for a while. Mom and pop are fine. They can go for a while. They termed out, 60% of the mortgages have no mortgage, or 60% of the houses have no mortgage, or 40% or whatever. And then, another 60% with mortgages are under 3.5 or something. So they turned out their debt. So who's the sucker at the card table? Who's going to go broke first? Treasury market's going to break first. Mortgage backs might break first. Duration as a duration product. But this is a day where we're sitting here as we're doing this. The Treasury just issued $127 billion in treasuries today. Both auctions were sloppy at the short end, 2 and at the belly, really 2 and 5 year. After a ugly 20-year, which is again a bit of a wonky duration last week, but still, it was ugly in terms of an auction.
Yeah.
So the last 3 auctions have been bad. Oh, by the way, the last 3 auctions, when you total them up, are equal to about the annual deficit that the U.S. ran in 2002, the year before we invaded Iraq, and in 2007 after a 5-year housing bubble. So like 15 years ago, 17 years ago, this was what we've issued in the last 4 trading days, has been the size of the annual deficit. So the point here is that corporations have staying power. They're not going to go bust first. Households have staying power. They're not going to go bust first. Treasuries are where we're already seeing the dysfunction, and we haven't even gotten into a real slowdown.
Yep.
And they have a printing press. They have a print. Luke, they're not going to nominally default. They can print the money. I say, exactly. So
this gets at the exact heart of why I'm asking this question.
Okay.
Because what you're talking about is the speed at which they're going to respond and the magnitude that they're going to have to respond, because, and these are your words from, multiple times you've said that each time they're intervening, they're turning it into an on-off switch, and not like this 2008 isn't even a good example, but all the bubbles that burst that took years to kind of play out, that the impairment that took place over a year, 2 years, and you got this reset, and then they reflated it. But in 2020 with COVID, the response was so fast, and I think it had to be that fast for them to deal with the unprecedented amount of impairment that they have created through all these years of manipulation and how fragile the whole thing has. This next, call it cascading impairment, that was trying to manifest itself with the Silicon Valley Bank crisis that they completely plugged with the backstop facility and said, oh, that's not going to happen, right? As soon as that tries to happen again, Why would they do anything different, Luke? At this point, they have to plug these holes immediately. They have to flood this system with more and more fiat at like in days because they know how fragile this system is, right? So if I'm Buffett and I'm sitting here on $167 billion of cash, isn't he the patsy at the table? Because I think he is.
I would argue with cash, he's okay, right? He's getting paid 5.25%, right? Whatever he's getting, five.
Yeah,
like,
yeah.
And he's taking no duration risk. So for me,
true. That's very true.
I don't think owning 5% treasury is a bad. Like if I'm him, that's exactly what I'm doing. Now, whoever's holding whatever it is in duration, they're the patsy, right? Everything beyond kind of 7 years and out, they're the suckers at the card table. And it's really interesting. On day we had Larry McDonald pointed out, we had a 20-year treasury auction that was fugly. And there was a Cisco bond auction. I don't think it was a 20-year. I don't know what the duration was. But the point is it was 6 times oversubscribed. So it's not it's a sovereign issue. It is we don't want infinite long-term paper.
Yeah.
And there's a So to answer your question, to me, the variant perception is that the sucker at the card table is the long-term treasury market.
Yes.
And I think the other variant perception is that the bear case on a lot of things, we'll just say that, the bear case on stocks in particular, but, Bitcoin, gold, blah, blah, is that we get a downturn in the economy. We quickly get another episode of treasury dysfunction. And instead of BTFP in 1Q23, instead of Yellen switching duration issuance up to the front end to tap the reverse repo and what was essentially synthetic QE in 3Q, the Treasury and Fed let a Treasury auction fail and they stand aside. And they let another one fail and they stand aside. People say, oh, they'll never happen. Well, we had a 5 basis point tail in a 30-year in November. James Lavish has talked about that and highlighted how bad and inconceivable that was at the time. We just had in a really good liquidity environment, 3.3 basis point tail on a 20-year. I don't think you need to we're not that far from that point. So to me, the bear case on risk assets broadly is you start getting a series of failed treasury auctions and they stand aside. And then that illiquidity starts to cascade and that starts to lead into some bank failures and they stand aside. And when I take a step back and say, okay, what are the odds that happens? It's like Mark Baum or Steve Carell as Mark Baum, right? Steve Eisman and Big Short, right? Like 0. That's the odds of that happening. Yeah. And so then if we work backward from that, you go, huh.
Well, isn't it interesting that we saw Jamie Dimon say today that that they should be allowed to buy some of the smaller banks or to merge the smaller banks, literally today.
Oh, really? I didn't see that.
Yeah. Yes. Yeah. JP Morgan CEO says should allow some of the smaller banks to merge. I mean, it is such a, I like your point though. And I like your framing that he is in like very short duration cash position. So he's collecting his 5%. I would argue that any developed currency, M2 is growing at 7 to 8 to 10% on an annualized basis. So if he's collecting 5%, he's only getting chewed up by, let's say, 200 to 400 bips. And that's obviously smoothed out over the long haul. But it's almost like, well, what are you going to do with this? And so, like, I guess people are looking at the markets, right? And they're looking at the index and they're saying that this is the market. But the indexes are being driven by 10 companies, right? 10 companies are driving those indices. But if you look at like the Russell 2000 and you look at the rest of the market, it's still down from the high from 2 years ago, right? Like,
yes,
it's still like, and so I think there's this talking point that, oh, everything's just booming along. And it's like, no, everything's being consolidated into like 10 companies and they're just gobbling up everything. Everybody else is pretty much struggling. You got, legacy people just squatting on cash, thinking that there's going to be some type of correction. And I think that the string pullers, the 10 people sitting in the room, are going to continue to just swoop in the snap of a finger. They're going to flood the liquidity. They might let something play out over a weekend, right? Like similar to the Silicon Valley Bank. Are they going to save them or not? Well, they did save them on Sunday night, right? But from Friday, Saturday, when the markets were closed, they let everybody think that there was going to be this free and open market, only to find out Sunday that, oh, nope, we're going to save them after all. And there's Yellen keeps running out there and saying that there's not going to be any more, crashes anymore, Luke. It's just going to be up and right forever. For
maybe there will be nominally.
Yeah, I think that's the point, right? So if you're sitting on cash and you're watching all of this and you're saying, I'm going to get a chance to, like, maybe you won't. Maybe
I think you have to at least consider that. I mean, I know I'm absolutely considering that, because you get into this. We're into this really weird time where you can start gaming things out, right? So inflation is picking back up. You can see the supercore has risen 3 straight months in a row. People are starting to say, oh, higher for longer. Okay, well, yeah, let's do higher for longer. What does that do? Higher for longer, starting from a point of 5.25. Well, the average interest rate on the U.S. government's only 3.1% right now. That'll reset over the course of this year to call it 4 on 35 trillions, trillion 4, which is real money. Still, for now. No, in trillion 4. So that's a trillion 4 in increase to the deficit. Now, is the U.S. government going to cut the combination of defense and entitlement spending by $1 trillion to offset the interest? And obviously they won't have to cut it by $1 trillion. They'd have to cut it by, I don't know, it's up from 600 billion a couple years ago, right? So say it was 2% on. Okay, so 600 billion when they started, and now you see you're up 800 billion. So I got to cut it. $800 billion cut to defense and entitlements. That's 20% cut forever to entitlements and defense. Well, that ain't going to happen. So now your deficits are going up. Your deficits are going up, but your private sector is very sensitive to interest rates. It has been kind of masked for the moment, right? We're doing extend and pretend in commercial real estate. We can see the markdowns happening, but there's sort of this, workout. Hey, don't take the marks for the banks. Okay, great. Housing, we have this gigantic bid-ask spread that has opened up nationally between what people can afford and what people want to sell for. And so what that does when you raise higher for longer to fight inflation on the private sector is private sector income falls. So now we're in a situation where deficits go up, private sector income comes down, nominal GDP stays flat or rises to some degree. And that's the exact same thing we did in COVID. Deficits up. Mm-hmm. This is just an interest stimmy, $1 trillion interest stimmy every year at 4%. Raise rates to 6. Eventually, you'll get, I don't know, assuming the curve isn't wildly inverted, say you just go a flat curve at 6. Flat curve at 6 on 35 trillion in debt, trillion 8 to 2.1 trillion. It's a lot of money every year. 2.1 trillion on today's GDP is 8% of GDP. Stimming. That's just cash out. And yes, it's not to everybody. It's just to wealthy asset holders, but they'll spend it eventually, especially the boomers, because they're not getting any younger. It gets out in the economy. Meanwhile, the private sector that's interest rate sensitive is going to reprice slowly, all at once. So my point here is that higher for longer is not really going to fight inflation. It's not going to really slow the economy. At the same time, if you're Warren Buffett, if you're corporate America with 4 or 5 trillion, what's Warren Buffett's pre-tax operating margin? Let's say they go to 6-7%. Let's say rates go to 6. Let's say I don't know what his pre-tax is. I have no idea. I'm assuming across a lot of his portfolio, it's probably 10, 12, right? A bunch of insurance companies, building products, oil companies. This ain't friggin' Apple and Google. If I'm Warren Buffett and rates are 6 because of higher for longer, and my pre-tax operating margin is 10, and then I have to deal with, if I want to invest in CapEx, I've got to do the planning, I got to do politics, I've got to do the, why would you ever spend capital spending risk adjusted 10% pre-tax margin when the government's paying you 6 to sit still? I wouldn't. And I don't think anyone else is.
Yeah.
I think corporate America will sit there and clip the coupon from the government.
Yeah.
Now you're in real trouble because now your capacity is not going to grow. Your interest expense, your deficits are going to grow. Your private sector capacity to address those deficits is not going to rise. It's very secularly inflationary. And this all gets into what I've been kind of talking about for a long time, which is the Fed screwed up by not letting inflation run hotter for longer to get that to GDP down. Because now, great, go higher for longer. We're going to get more inflation. Don't go higher for longer. We're going to get more inflation. And that's why I think the long end is the sucker at the card table.
One of the most interesting Berkshire shareholder letters that I've ever read that I think is actually more pertinent than the one he just wrote is the one from 1984. And when you look at the timing of this is like 3 years after we literally peaked out at interest rates here in the US, which peaked out in like 1981. He writes this shareholders letter. And one of the things, and this has stayed with me for a very long time. One of the things he talks about how do you deal with inflation? What's the most opportunistic way that a company can deal with inflation? And he talks about having as much intangible assets as possible on your balance sheet as opposed to tangible assets. And the reason why he's saying this is because he's saying the replenishment and the working capital and the CapEx of replacing physical things on your balance sheet get really expensive when the inflation just keeps running, right? But if you have, let's say, and I don't remember what example he used because this was quite a few years ago that I read this. But like as an example, let's say you have a Disney DVD and you have like the Disney brand, right? It's a very powerful brand. A person goes to, they're in Walmart and they're looking at movies that they want to buy, or they're surfing online to purchase a movie. They see Disney. They're like, okay, so that's probably a decent movie and not some like off the shelf like movie I've never heard of. So it has that intangibleness of the brand and the digital file that you can download off of the internet, right? You can adjust the price of that, and there's nothing physical that you have to do to have the person download that movie for all intents and purposes, right? But let's say you're an apartment building owner and you got to replace the shingles on the roof every so many years, or you got to put in new steps, or you got to do all these. It's very capital intensive, and as the prices are going higher and higher, the price that you used to own it at is drastically different when you're dealing with inflation. So when you look at the composition of the balance sheet, and I'm saying all of this as I'm comparing and contrasting Berkshire Hathaway versus MicroStrategy. One has a ton of intangible assets on their balance sheet, probably the most intangible asset a person could ever hold. Warren's trying to do it with, I guess, short duration treasuries is his play in contrast to what we think the new settlement layer might be. And everybody has their opinion on how this is going to shake out. But I find it really fascinating that when you're thinking about how to navigate this as best you can, because it is going to be, I think this coming 10 years is going to be wild from what we see from an inflation standpoint. I just find that shareholder letter is just so such good guidance if you employ it correctly. So sorry, there was no question there. I'm just
No. Well, it's interesting too, right? Because if you think about, like, this one blew me away. I remember being in a meeting with a company up from Brazil. Mm-hmm. This is a former life or two ago, and I remember it was after the 08 crisis, right? We had started QE, and it was like, okay, well, help us understand inflation. And I said, well, you'd probably want to own buildings, and he goes, no. Actually, there's a point after which they actually fall rapidly in price. If inflation gets too high. And I'm like, wait, why? And he goes, because the marginal buyer is based on credit. Mm-hmm. And at some point, the banks stop lending against it if the inflation gets too high, right? No bank is going to give you a 30-year loan on a building or on your house when inflation's 20.
Bingo.
Right? Because so things start falling to cash value. Now, we've not seen that, but what's really interesting is how much the housing market is like gone to a cash market. I don't think that's why it's happened. It's just it's interesting to me, but it speaks to the point of the initial point speaks to the point of what Buffett talked about, which is if you've got a bunch of hard assets on the balance sheet that are where the marginal cost of replacement is based on a levered price, right? You've got to borrow the money to buy it. If inflation gets too high, the value of that falls sharply because you won't, the credit markets won't issue the credit any further than 2 years, 5 years, whatever.
And we're talking about developed economies where, most global citizens are dealing with exactly what we're describing because they're not living in the United States or Europe or wherever. They're dealing with this up close and personal. If you're in Argentina or you're wherever, right? Like you are dealing with these ramifications up close and personal. And so, before we started recording, you made the comment, the last 3 treasury auctions were a disaster. And I'm shocked at how well Bitcoin has just been ripping in the face of that because it normally, you would think that it wouldn't. Explain what you mean by that. I know we're pivoting away from the conversation.
Sure, yeah, no.
This was such a fascinating comment that you made early.
Yeah, so the 20-year was really bad. Today's they weren't great. They were terrible. I wouldn't call them disaster, but they weren't great. Particularly given where the dollar is, right? So the DXY, you tell me where the dollar is, I'll tell you how weak the auctions will be. The stronger the dollar, the weaker the auction. So the dollar basically hasn't moved in 3-4 months, and yet the auctions keep getting weaker and weaker and weaker, which tells you if at some point we're going to get a really weak, they're going to need a weaker dollar. Anyway, to speak directly to the question, historically, you get an ugly auction, like you had, Thursday and these two today that are soft. Very clear reaction: dollar up, gold flat, everything else down, and Bitcoin sort of being like a beta, a beta to the Nasdaq. And instead, we're starting to see bad auctions. Dollar flat, stocks flat to up, gold up, or certainly outperforming the treasury, and Bitcoin up, which is, I want to be careful not to play 5-minute macro. If we see this continue, though, this is the market beginning to recognize, long-term treasuries and cash are melting ice cubes. I have to go into every bad, historically bad auction, bad for stocks. There is a point where you're going to go bad auction. Oh God, bad auction means much weaker dollar. They're not going to let auctions get too bad. I need to own stocks. I need to own Bitcoin. I need to own these, I need to go all these. And my view on what I meant when I said that is, it's early days, like very early days, but we're starting to see markets react like this. And this is, the guy in Cleveland can kind of figure this out. It's probably, the market's probably already there on some level. So
does this keep playing out into the end of the year? Do you think that scenario is going to continue to replicate itself, or do we get a little bit of a lull and then maybe later on it picks back up again?
It's such a political process, right? So let's caveat it with that. I think we have a government possible shutdown coming up right in the next few weeks or something, don't we? So do we have a debt ceiling or some sort of thing coming up in the next few?
I don't know, but that wouldn't surprise me.
I thought maybe I'm mistaken. At any rate, I'll put it this way. I think the trend is in that direction now. Why wouldn't it be? The government has made it crystal clear. Fed, Treasury have made it crystal clear that Treasury dysfunction will not be tolerated for very long. Full stop.
Yeah.
And if that's the case, I just think I think, markets are forward looking. And so I think it may be an interesting inflection point of exactly that, where you move toward this, bad auctions have been bad for everything. Treasury dysfunction has been bad for everything. There will come a point maybe where bad auctions start to, it's like Pavlov's dinner bell, where it's like, okay, comes liquidity because they're not going to stay on this for very long. And so it definitely caught my attention to see Bitcoin up. I jumped on today, it was up 4 or 5% on, on a day where you had two auctions following an ugly auction last week.
Today, we are seeing, and this is a month and a half after the Bitcoin ETFs launched, IBIT, which is the BlackRock ETF, has done over $1 billion in volume just today, and we haven't even closed out the market today. What is the conversation that's happening inside of large banks and institutions on something like that? Is it even talked about? Is it the top talking point within institutions? Help us understand, for people that have never set foot in one of these large banks on Wall Street. What does that conversation look like or sound like? Or is there no conversation whatsoever?
I talk about it a lot, so I'm probably not the best gauge of that, right? I talk about Bitcoin a lot, right? So it was certainly relative to most strategists. So I might not be the best reader, but my sense of it is, I don't think it's much of a conversation yet, even, in the same way that the gold isn't much of a conversation. So they're just, most of Wall Street, I think, still is the volatility of Bitcoin make it very difficult to own for even those investors that could own it. And there's a lot of them that can't own it. And so I think the ETFs probably are an important step in terms of making that easier to do. I'll phrase it as how somebody said it to me a few months ago as it relates to gold, which is, what if if I own X% my portfolio in long-term treasuries and I lose 30%, oh, well, so did everybody else. And if I put I put that same percent gold and I lose 30%, I get fired. And so my guess is it's probably a pretty similar view, at least yet, as it relates to Bitcoin, in terms of, if I put 5% of my client's portfolio, or if I own here, and it's, there's, I think, still a lot of career risk probably associated with being an early adopter on that front. And so I would be surprised if there's a lot going on in terms of hey, okay, we need to own, other than sort of, forward thinking people with a mandate that allows them to go into the asset class, and further with a mandate that allows them to absorb the type of volatility that Bitcoin has historically had, right? And which just is what it is. It's whatever, 80% annualized volatility, 87%, whatever it is. It's going to go down over time. It has gone down over time, but for most people, it's still way too high. So it's kind of stream of consciousness. I hadn't thought too much about it to this point, but that, I think, gives some framework around, how I'm thinking of a stream of consciousness.
There was a person on Twitter. I opened up questions on Twitter. There was a ton of responses of people wanting to ask you questions. There was a person who said, in early 2023, what flipped you from a bear to a bull while the perma-doomers were out, and completely missed probably one of the best market moves in 2023? What were you seeing at that moment that made you say the liquidity's coming back on?
So it started in October of 2022.
Yeah.
You could clearly see the Treasury auctions not doing well, Treasury volatility up, blah, blah, blah. There was an IMF meeting. The dollar was discussed per numerous media sources. Yellen runs down the TGA. The dollar starts weakening rapidly. Risk takes off. And late October, mid to late October and into early November, I was watching the dollar trade, markets trade, going, okay, something happened here. Mm-hmm. So what was it and how significant, how long lasting is it? That increase in liquidity, the dollar weakening is basically a de facto increase in liquidity. I think into like February of last year was probably the first time I saw Warren Mosler, MMT, really MMT guru. I don't call a lot of people gurus. He's the guru. He's highlighting the dynamic that the rules are different for monetary policy when debt to GDP is over 100%.
Mm-hmm.
And I sort of had noticed those dynamics. I'd written a lot about those dynamics, right? I spent over and over, hey, true interest expense of raising rates are going to send interest and entitlements over receipt, that'll work, and blah, blah, blah. And I had never thought about the opposite side of the same coin until he had started saying a few things and kind of highlighting that there's a stimulative aspect to that as well. And it was like a light bulb went off for me. And I basically red teamed my own case and went, okay, we'll do this and this and this. And then, so that kind of started the thought process where like, wait a second, this is important. Then March, we had that sort of, it was a treasury crisis disguised as a bank crisis. What did they do? Treasury liquidity now. Did they let any depositors take a hit? No, nobody took a hit. So that kind of highlighted. And then Dan Oliver, Mermacan Capital, had a really good missive in May highlighting from a different angle, but directionally similar to what Warren Mosler was kind of highlighting in terms of the rules are different when you raise rates really aggressively on debt to GDP this high. Mm-hmm. And it was really, I think, just kind of that process of, okay, yes, that makes sense to me. I'm seeing something in the markets. I don't know what I'm seeing, but something might have changed. October, and then, okay, February, March, when they reacted the way they reacted in March, was like, okay, this is, I felt like Dennis Green, like they are who we thought they were. And, that you could kind of continue to see that and see it play out in markets. And so that, at least up until the August timeframe, that really was what drove those changes, was just, it was kind of like a punch to the chin of like, wait a second. Oh, yeah, that actually makes sense. And then red teaming that case, red teaming my own case and just look, when I'm wrong, I don't dilly dally. I start to flip.
So the backstop facility, the BTF, right?
BTFP.
Yeah. Sorry. So it's getting turned off here in March. When we look at the maneuver that they did last month, they basically closed the spread that the banks were basically getting this amazing free money out of the facility. They closed that window because I think as it was getting ready to close, the amount of participation in it was like starting to skyrocket. And I think they were like, all right, these last 2 months, like let's cut off the gravy train so it doesn't look like the thing goes parabolic into the close. And so they've done that, and surprise, it just like flatlined, like a dead patient as far as the use kind of ramping from here till the close in March. My question is it seems like that was a major source of how liquidity was getting into the system to reflate at least the top 10 performing equities in the equity market. But once this thing closed down in March, what mechanism are they going to use in order to keep this liquidity flowing into the market? Because there's no way that they can prevent that or cut it off at this point, especially with everything else that's brewing in the background. So what becomes that transmission mechanism for them to continue to apply liquidity into the system moving forward?
I think of BTFP as almost like a counterfactual liquidity driver in some way, right? So like we know what it was. It was basically yield curve control for banks.
Yep.
All right. So instead of you having to sell your treasury down 20%, you can flip it to us at par for, so, all right. So that's going away. I don't know what bank securities books have done to reposition. That's probably something to know. I think the bigger liquidity drivers in the last year BTFP helped on the margin, but I think the biggest liquid drivers are what the dollar did, right? So it went from 115 in fall of 22 to, gosh, 100, 102 by like January, February of 23. That's a huge, I mean, a 5% move in a major currency is enormous. Like that was a 35% annualized move in like 3-4 months in the global funding currency. So I think that had huge, that was just like a bolus of liquidity to kind of work through in fits and starts unevenly through last year. I think also it was then aided by this shift in liquidity. It was effectively QE, synthetic QE, what Yellen did, right? So when you do QE, the Fed, there's a reduced supply of duration, long-term bonds, increase loosening financial conditions, dollar goes down, stock prices go up. When Yellen shifted issuance from the long end to the front end, bank reserves go up too, right? Bank reserves go up to create, they're created through QE. Those are the mechanical outcomes of QE. When Yellen did what she did, duration supplies were reduced, financial conditions loosened, bank reserves went up, stock prices went up, and the dollar got weaker. So the drain of the reverse repo, it was just going from one pocket to the other, right? The reverse repo was just QE we did and we sterilized, and then we brought it back in when we needed it in the fourth quarter. I think that's gotten us to here. We've got whatever, 400, 500 billion left on that. I think that gets you there. That gets you, several months at least. You can run TGA down. I think the TGA last I checked was still, I don't know, $600-700 billion, something like that. So you can kind of run reverse repo down through the end of April. Then you can run TGA down through the end of third quarter. Then you can get an election and then you can figure it out. That basically you can sort of glide it through. Maybe you weaken the dollar, from 104 down to 102. Those are all stopgaps. Now,
that's why you're saying you think the dollar is going to go down into.
They have to. The dollar. I think the dollar is going to they're going to continue to decline on an orderly basis through the course of this year. The big kahuna to me for liquidity is a dollar devaluation.
Yeah.
If you can get the dollar from 104 to 92 by, I don't know, mid 2025, right? So you've got these stopgaps you can get you through the election. On the other side of the election, let's say the dollar's at 102 on election day. If you can get that from 102 down to 92 by 4th of July 2025, 3Q 2025, you're going to get a turbocharging of liquidity. That will help a lot. That will help stabilize treasury auctions. It will send inflation back higher again, but that's what you need. That's what I think is the next step. And what I think is so interesting as it relates to this, it needs to happen. Treasury needs it to happen. The economy needs it to happen. The world needs it to happen. China, everybody needs it to happen. Is that we've had Biden and Xi meet in November. Dollar all of a sudden weakens away from that against the yuan in particular. We've had two treasury meetings in Beijing, which is a pain in the rear end to fly to. 2 treasury meetings, high level, in the last 4 weeks. No comment on what they're talking about other than sort of the generalities, with one exception that I thought was really interesting, which is they wanted to talk to China about making sure they do not dump product onto global markets. That's what they said after the first meeting. And then last week, Treasury openly warned China again, do not dump product on global markets. So everybody thinks the dollar's going a lot higher, but Treasury's warning China not to dump product on global markets. That's not higher dollar action. That's lower dollar action. They don't want deflation, right? If they don't want you dumping product on markets, that would be higher dollar, all else equal. Higher dollar against the yuan. That's literally what Treasury is saying. Don't do that. When we were warning the Japanese in the 80s, stop dumping in dollar markets in 1984 and 5, DXY was at 166. 2 years later, after the Plaza Accord, it was at 85. And so I think there's a real shot that Yellen and Treasury are negotiating right now an orderly weakening in the dollar between now and mid to late 2025. And if you do that, you'll have all the liquidity you would need. That's not, we know that because we saw the dollar go down 20, 30% on an annualized basis, 10% practically speaking, not even 8%, 115 to 104, 4Q into 1Q, 4Q 22 into 1Q 23. And you got what we got in 2023, which is like first half of the year was like party on Wayne, party on Gar.
So what does that conversation sound like? Hey, if you help us out, just let us, debase the dollar here, let it go down to a DXY of call it 90. Then you're not going to have to deal with the president that was in office prior to the current president. Is that like what the conversation sounds like to them to try to get them to buy in?
I think the conversation is you let us weaken the dollar to 90. You help us. Yeah. You buy some treasuries. We let you buy oil from the Saudis in yuan, because that way, reality is if the dollar weakens to 90 and oil goes to 120, that screws China too. And right, so like a strong dollar or strong oil, when you're short oil, if you can only buy the oil in dollars, screws you either way. It's 6 of one, half dozen of the other. So I think the deal is help us weaken the dollar. You'll buy more treasuries and help us stabilize the treasury market. And we'll let you buy oil from the Saudis in yuan, as long as they do not recycle the yuan they end up with into Chinese government bonds. That's a no-no, in my opinion, because that's effectively financing the Chinese military. Semantics, but I think that's just, I don't know. I just think that. So it'll get recycled into Chinese goods. It'll get recycled into gold. Maybe someday it'll get recycled into Bitcoin. I think that's, that would be down the road, but that's what I think. Again, I have no inside government sources. This is speculation, informed speculation, but that's what I think the deal is. Weaken the dollar, you buy more treasuries, you get to buy oil and you want. Don't recycle it into CGBs.
So they won't have to start weakening the dollar until they kind of run out of these other mechanisms that they've been using to date. And so you're thinking around maybe early summer is when the dollar weakening would really kind of start kicking into high gear, or what?
All else equal, it wants to go higher, right? So they're kind of fighting it now.
Yeah.
And so it's a little bit of like, how quickly, they're in a firefight against the dollar, and they've got, 400 billion in bullets, 500 billion in bullets in the reverse repo, and they've got, 700 billion in bullets in TGA. You total those up, $1 trillion, $1.2 trillion in bullets. When you're burning, yeah, it's going to be close, right? Because you look at whatever, they're running a $1.7 trillion deficit annualized rate. Now, I think tax receipts are probably going to be pretty good in April because the market was so good last year. Yeah. So again, if you get good tax receipts, that buys them a little more time. So my view of Janet Yellen has changed radically in the last, call it 18 to 24 months. Okay. Like I've gone from, she's just very good. Like she has demonstrated away from, she's very good at the real politics, that she just seems to understand these dynamics of, okay, this lever here, I need to get the dollar down to make this auction work over here. And then if I pull this and the Chinese want this and the Russian, like she seems to be.
She understands what the transmission mechanisms are.
Exactly. And that's, I mean, I think what she did in November was shifting issuance forward, I think was a clear indication of that, right? It was like, okay, the treasury market is like the way she was able to offset what Powell was doing. 3Q22. Everyone was like, look at Powell. He's the man. And she's like, watch this with the TGA. yeah, run down the dollar. Okay. So then she comes in, BTFP. I think she's very good in terms of understanding the real politic and the levers that she has available to herself.
You heard it here first, folks. We break news all the time. Luke Gromen really likes Janet Yellen.
I gotta give props where props are due. She's been very impressive. I mean, she is like juggling like 16 chainsaws, and she's so far so good.
I get your point. I think she does understand the levers, but let's talk about so what really performs as Janet continues to pull all these levers and manipulate the legacy economy so well. And by so well, I'm using air quotes here. So what performs into the end of the year? One of the most common questions I get asked from family and friends is, Preston, where do you personally buy your Bitcoin from? And the answer is really simple. I buy it on river.com. Not only can you easily buy Bitcoin with zero fees on recurring orders, you can have peace of mind knowing Bitcoin on River is held one-to-one in multi-sig cold storage, all while being fully licensed and regulated in the United States. Plus, their relationship managers are US-based and available by phone for you or your business. Additionally, River has built their own infrastructure from the ground up, which means they don't rely on third parties to function like other Bitcoin exchanges. River also just created a new feature not found anywhere else called River Link. It allows you to send Bitcoin over a text message to easily orange pill your family, pay a friend for dinner, or send a gift. There's a new standard for investing in Bitcoin, and River is setting it. Go to river.com/fundamentals and get up to $100 free when you sign up and buy Bitcoin. That's river.com/fundamentals.
I think
say the obvious one.
Bitcoin. I like Bitcoin. I said to somebody who asked the question on the thing, Bitcoin's one of my biggest positions. And I think Bitcoin over TLT, gold over TLT, S&P over TLT, S&P industrials in particular. I prefer the industrials over the broader index for the reasons you cited earlier. It's
do you have a for that?
I think it's S5INDU maybe, or S5INDU, something like that. The one I use, but I like the
yes, that's right.
And the reason I'm going over TLT, I mean, if you look at since 2014, when global central banks stopped growing their holdings of treasuries, stopped growing FX reserves, S&P over TLT, gold over TLT, Bitcoin over TLT has been more volatile, but it's the same trend, just way more volatile. It looks like that it looks like that gold in Weimar German Reichsmarks chart month to month.
Which is really interesting because I think most would agree that the bedrock of the legacy system is long duration U.S. Treasuries.
The 10-year Treasury. Yeah, and the TLT is technically the 20 plus, but it's exactly. That's how I think about it, and it is, to me. And you're seeing it. We've had 3 days, 3 soft auctions. Gold has gone down less than treasuries, every single one of them, for example. Bitcoin has actually gone up, so stocks have actually gone, they've done well relative to them. So you can just see that. To me, those are like the gauges. Those are sort of the positions. I don't necessarily, other than trading, do I think that the 10-year yield is going higher? I do. I don't know how much higher, but to me, I think the better plays on this are understanding that liquidity has or will continue to be applied to manage the treasury market and keep it stable. That is the bottleneck, right? Treasury market stability is job 1 and job 2 and job 3 and the bottleneck. And as a result, the release valves will be those other things going up. Yeah, you can see. Yeah.
So I while Luke was talking, I pulled up the chart of the S&P 500 industrials. I have the chart, the timeline starting at the top right before COVID happened, and I'm comparing it to just the basic S&P 500. You can see that the performance over that period of time is about 6% higher for the industrials over just the S&P 500, which I think is pretty interesting.
About 7% lower. Actually, the green is the the industrials there.
Oh, I'm
Orange is
sorry. Yeah.
Oh, that's okay. Yeah.
Now I'm just fast forwarding through time so people can kind of see how the performance. It seems like right in here it started to
Turn around the other way over.
Yeah.
Which is really interesting, right? Because you think about what we talked about before of higher for longer, more inflation.
Yeah.
That's exactly what you'd expect to see. You should start to see stocks flat to up with the industrials outperforming the prior leaders that we had. That's also a weak dollar regime, right? If as people get the sense the dollar is going to weaken, you're going to see industrials go up, and you're going to see big tech maybe not as strong relative to those industrials.
Luke, if you were going to because I think for a lot of people that maybe listen to this conversation and maybe aren't intimately familiar with finance and the jargon and stuff, what would be your really simplified overview of what they can kind of expect point now till maybe the end of the year, that just kind of provides just a general overview in really layman's terms? And feel free to make it really layman, like really step it down.
I think inflation is going to pick back up. I think stock prices are going to pick back up. I think you will get talk of rate cuts going away and possibly even rate hikes. And I think the surprise will come around mid-year when the rate hikes don't come.
Boy, isn't that
even with inflation picking up?
That is super contrarian to what everybody's expectation is right now.
Agree. Everyone that is like, okay, they're managing this thing for inflation. That will be the moment where they go, oh my God, they're managing this thing for deficit. They're managing this thing for treasury functioning. Holy cow. That's when you're going to see fireworks. And then I think you actually get a really good back half of the year in terms of risk assets, right? Because there's a whole lot of money not positioned for that.
Yeah. It's funny. Larry Summers, everybody's favorite person, recently had a very similar tweet that he said that he thinks that they need to be looking at hiking and not, lowering interest rates, which when I saw that, I was like, coming from this guy and the fact that he's saying it tells me that there is some major cognitive dissonance between what everybody on Wall Street is saying is coming next versus what some of the elite politicians and I'll leave it at that are saying or muttering. So it seems like you have a very similar opinion to what Larry was throwing out.
Yes and no. I mean, he's talking about that, and I think markets are taking away the rate markets are pricing that away. I don't think they're going to do it though. And that to me is the big surprise is that they should do it, but they won't do it.
But they won't.
And when they don't do it, when they should do it, to me is I think going to be an aha moment for people. A lot of people that are positioned in terms of like
sitting on 167 billion in cash. Those people.
And 4 to 5 trillion elsewhere, and 6 trillion in money market funds. I think there's 6-7 trillion money market funds. It's the fiscal situation is so different than most of our careers that people just have a really hard time factoring in that it is dominating the dynamic.
Because the long duration, so let's say that scenario that you just described plays out. Anybody who's sitting in long duration is just going to be murdered, on the spot. Right?
And this is, this is the other side of the argument, and it's a very valid argument, which is the long end. Yeah, it takes off like a scalded cat. And now what do you do? And I think that's what Powell's worried about, rightfully so. But again, okay, raise rates. Take them up to 6. Take them up to 6. Raise rates 300 basis, 75 basis points. Now you're going to reprice more you're going to drive a private sector. You're going to drive a private sector sharp fall. So when it falls off, it isn't going to be it's going to go down 5-10%. Again, because we've got this bid-ask spread in commercial real estate. We've got this bid-ask spread in housing. You're going to go from the offer side to the bid side on a lot of stuff.
Mm-hmm.
It was really, really interesting. I mean, let me finish the thought before I do that. When you do that, your receipts are going to drop non-linearly.
Yes.
When your receipts drop non-linearly, as your interest expense is repricing up non-linearly, Yellen's going to come back for the, they could try to raise rates. Maybe they do, right? Okay, whatever. She's going to come back for the July thing and go, ooh, receipts were way below expected. Expenses are way above expected. The deficit for the calendar third quarter is not 425 billion. It's 900 billion. And guess what's going to happen to the long end then? It's going to take off like a scalded cat. And
no
so
matter what, it's going to happen. Yeah.
So and that to me is really the variant perception, which is Powell's choice is not inflation or deflation. It's how does he want to make the long end take off like a scalded cat, and sort of what timing and what sequence of events. Ultimately, I think you move to some sort of new QE or yield curve control or 4-letter, thing that isn't QE, that's a liquidity injection, blah, blah. You got to get the dollar weaker. The liquidity's got to come one way or another. But that to me is really the variant perception.
The patient's dying. It's just the pace at which we kill the patient is really kind of the.
Yeah, like this whole, the patient, you say patient, it breaks to mind. I keep hearing, well, we need to tighten and fight, finish the job on deflation, or we need or on inflation. And to me, it's like a bunch of docs sitting around an 85-year-old, 500 pounds, lifelong smoker, stage 4 pancreatic cancer. And one doc's going, we need to,
we can save him.
We can save him. We just need to get him on a treadmill. And the other one's like, no. Put him straight to CrossFit. And you're like, no, that's neither of those is the right answer. The right answer is you put the morphine in and you push the button and you let him keep pushing the button until he's dead. Like, that's it. And till he's dead in this case is now, you got to inflate the debt away, cap yields, basically get debt to GDP back to 70 to 80% so that you can then run into monetary policy without doing what they're going to do by raising rates with debt to GDP at 120.
Do you think that this, and I'm sorry to keep going on because we're kind of at our hour, but do you think that these Bitcoin ETFs are somewhat of a saving grace and maybe something that can help this transition of this dying patient over to something that gives us hope and prosperity and actually solves this problem? Like, this is my biggest frustration. You can listen to nearly any macro conversation and everybody is an expert at identifying the problem, but literally nobody can identify the solution to the problem, right? When I look at the ETFs, sure, you're not holding the keys, and sure, the government could step in there and see that as a honeypot and take a 6102 like they did with gold back in the 30s, right? With all of that said, those are the risks, obviously, with the ETF and not self-custodying your coins, but there's a lot of people that just can't figure out the tech to hold their coins or whatever. And there's tons of arguments. But when I'm looking at this, it's providing something that can actually provide a store of value to this patient that's just dying that you can port over to something else to try to bring sanity back to the world, because it's not just the US, it's every central bank is dealing with this exact problem. That's why they're so coordinated, is because they're all collectively together all over the world trying to manage the death of this patient that they all know so well and can define so properly. But until now, there hasn't even been anything for them to port it over to, at least from a Wall Street. Like, I guess I'm envisioning sitting there, I trade a $5 billion bond tranche, and like, what do I do to protect that buying power that's jammed into that $5 billion melting ice cube, right? Especially if it's long duration. Like, what can they possibly do? And it seems like we have some hope and that at least some of this stuff is getting approved, and hopefully there's competition globally for this. Is that how you see it? Is this hope and salvation for this dying system that appears to not have a solution according to so many?
There's a solution. Like, the solution is pretty straightforward. Just inflate the shit out of the system, cap rates for a little bit, and like, that's it. But it's a political question, right? Bondholders have controlled this system for the last 40 years, and they don't want to get screwed on a real basis.
But Luke, so I want to push back on that. Okay, so when it's an individual country and they're having issues. Like if you're not a G7, right? Like that's the playbook that you just described. But what happens when it's literally every single country on the planet, to include the G7s, right? That are all trying to implement that playbook. It's a competition to the death, and at the end there's no solution. Like, what's the solution for them?
So I do think it's a possible solution. I have found it very interesting that, number one, I know for a fact, I don't know how widespread it is, but I know there are contingents in Washington who understand the math, as you and I have discussed the math.
Yeah.
In other words, like, maybe it's 6 months, maybe it's 2 years, maybe it's 5 years, but it ain't 10. It ain't 20. I don't know how big that contingent is. I suspect over the last 2 years, the contingent has gotten notably bigger for a number of different reasons. I also believe that push comes to shove, America will want to do the best thing for its citizens. It's in America's interest to do that. I'm also very interested in the timing of what I've seen transpire. When I look at, I'll start again with gold. JP Morgan, for 18 years, the GLD had a single custodian, HSBC. And at the end of 2022, all of a sudden, JP Morgan says, we're going to be the second custodian. And then in the first half of 23, JP Morgan says, we're going to move some of the gold out of London for the first time. 18 years this thing's been around. Never any interest before. Never out of London before. And then in the first half of 23, over half of the gold in GLD goes from HSBC's custodial vault to JP Morgan's. Now, maybe he just does he, like, why bother? Why bother? To me, at the very least, the rake on the fees are going to be, he's going to be better, right? His price goes up, right? They're getting a fixed price on a bigger number. Okay. So that was sort of strike one, if you will, in my mind of like, okay, why now? Why? That was just odd to me. Then forever, they've been fighting these, you know better than me, chapter and verse. They've been fighting these Bitcoin ETFs over and over and over and over. And to me, at least, as sort of, I like Bitcoin. I'm involved with Bitcoin. It's an important position for me. I'm not as in deep with all of the machinations in terms of getting these things approved as you were. To me, as sort of a tourist, it was like, no, 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 no. And then all of a sudden it was like, yes, 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 yes. And again, as a tourist, it seemed rushed. Why now? Why finally? Why, like, what changed? Maybe nothing. Maybe it's all
lawyers.
I think part of it might be like, okay, we know the dollar's got to be weakened because, oh, by the way, this is all happening in the context of what I laid out before, which is, look, if the dollar goes up, the treasury market is going to break. Full stop. Like, it is not, it's like, barring like Martians coming down in some miracle, like it is going to happen. It is a matter of national security for the US dollar to go down quite a bit, 10, 15% in an orderly manner, but in a fairly compressed time. If I told you the dollar is going to go down 10, 15%, you're running a bank. What are the first two assets you want access to? No opposition. They're the two assets I just said.
Yeah.
So, there's been a lot written about, okay, they're just going to grab the coins and blah, 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 blah.
Good luck.
And yeah, maybe. We know, right? Jason Lowery, we know there has been at least a conversation with his book, Soft War. There has been a conversation in Washington amongst the defense establishment about Bitcoin as a reserve asset. We know that. I don't know if that was like two guys in a room like you and I talking about it, or there were others. I don't know.
Yeah.
I also know that if we and I
can just tell you, like my experience with DoD is that it's just all funny money. Like, hey, I need another $1 billion to go buy this other toy that I'm working on. Like,
and that might be like
magic. It's just like magic. They're like Mario coins. Like it's
right?
not,
So like I could fix the debt problem tomorrow. Like it's pretty easy, which is every $4,000 of gold. So Yellen can go to Fed, say, hey, remonetize the gold. Every $4,000, $1 trillion in Yellen's TGA, no debt attached to it. Okay, 20,000 will give me 5 trillion. I go into the market as Yellen. I go buy back 5 trillion in debt. That takes debt to GDP from 120 to about 75 overnight. Thank you. Have a good day. Fed, you're separate again. You can take rates up to 8. You're not going to blow up the treasury market. You can let the private sector do what it's going to do. Voila.
Yeah.
Easy peasy. Now, that has geopolitical implications because guess who's sitting on a lot of gold? China, Russia. Do we want to do that? Do we have the gold we say we do? I don't know. What is, okay, I don't know. Now, if I wanted to really be like, I wanted to play 4D chess, do it with Bitcoin. You got what, 120,000 Bitcoin sitting in the, the dark Silk Road or whatever the hell it is, that they grab. Add a 0 to the back, add 2 zeros to the back. Say we're going to now, us and the Canadians and the Saudis are now going to accept, we're now going to settle in Bitcoin. It's the platinum coin trick, except sustainably going forward with a neutral settlement mechanism. The Bitcoin thing would be a lot, but the gold thing, like everyone just writes down, recaps through the gold.
I think that I don't think that actually poses a long-term solution. What I think is playing out, and I know your Jeff Booth's thesis about deflation, technological deflation, and we look at all this printing for all of these decades is just preventing this thing that's trying to birth itself, which is technological deflation that they've been able to hide and mask because of all the printing collectively across the G7 and beyond. And I think that the more that they try to double down on gold or the platinum coin or whatever, right? It's still a mechanism that requires human trust to manage a ledger to some paper that rides on top of it that never allows technological deflation to actually manifest itself. And it's desperately trying to get out like a monster that's like locked in a cage. Like it's trying to get out. And I think the only thing that allows it to get out is something that's truly decentralized that does not have a human in the loop to manage the ledger.
And it's tied to energy, right? And that's like,
thank you. Yeah.
If you came out, if Russia and China came out and said, hey, we now value gold at 1,000 barrels of an ounce, and every nation around the world can 1,000 barrels of oil per ounce of gold. Every nation can figure out how they want to manage their energy policy. Great. The price of gold is going to be X here. It's going to be cheaper there. It's going to be expensive here, whatever, based on your energy policy, your natural endowment, blah, 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 blah. That will incent the proper behaviors. Other than that, I agree with you. Just printing it up and papering it over. Yeah, it's simply kicking the can.
Yeah.
Now, doing, that gets into the, okay, well, how do you settle it? Well, it's sort of a no ticky, no washy kind of thing, right? Like if you don't settle it in gold quarterly, and oh, by the way, we used to send a flight of planes to Riyadh, either monthly or quarterly, full of bullion, back in, I think, the 40s or 50s, maybe even into the 60s. Wildly inefficient, not more inefficient than shipping this stuff around, water on, on trucks. But Bitcoin does the same thing. Like, and it's much more efficient to do it. And it incents the right behaviors.
10 minutes. I saw this just this past week. Somebody sent $1.2 billion on chain, cleared in 10 minutes. And I think they paid $2 in fees and they overpaid. They could have paid way less than $2 if they wanted to. I don't know how it
doesn't compete in the law. It doesn't compete. And no. And it's that energy tie that is so big because that's going to compensate for and incent the right behaviors. And when I say the right, I have no moral to it. The humanity advancing energy efficiency behaviors. Right has nothing to do with it. That's, nature wants to get more energy efficient. That's how it evolves. And that's why what I mean by right. I'm not vocalizing on anything other than that or opining on anything other than that.
Just talking about nature, man. Luke, this is always a blast. My wife, if she was here, she could attest to the fact that I have the FFTT weekly newsletter printed in just sporadically all over the house you came into my house, you'd find all these like reports. I read them because I text you sometimes on Saturday when I'm sitting in a swim meet reading my FFTT weekly report. Cannot speak highly enough. I mean, it is.
Thank you.
It is my go-to reading every week for sure. I always appreciate you making time and coming on. You're just a wealth. I learned so much from you. I don't know how you're able to parse all this together, but it is quite miraculous to just be a friend of yours and to be able to have these conversations with you. And I just want to truly thank you for always making.
Oh, thank you. I feel the same way about you. So it's there's times where I'll ping you where I'm learning something about Bitcoin or whatever, and it's hey, I am a toddler in my understanding of it, and I'm really curious and really dumb. So it's a good way to learn. So I appreciate you always humoring me. I'm sure some of the time, like, pretty basic question, but at any rate, I appreciate it. I really enjoy it.
Anything else? We'll have links to your books. We'll have links to the FFTT website and your Twitter. Anything else that you want to highlight?
No, it's
perfect.
People know where to find me. That's that's I appreciate you having me on. I really enjoy our conversations.
Thanks again, Luke.
Absolutely. Thank you, my friend.
Well, my base case is definitely a hard landing. The question is, how bad of a credit event do we have? I would be surprised if we don't have one between now and the end of next year because of just the sheer amount of leverage in the system and the rate at which we raised rates. And because it's not an even distribution of who has all that capital.